After Jerome Powell, we've got big tech earnings. Meta, after making all-time highs, is a highlight. Microsoft, another one that always seems to deliver right when you need them to. Joining us, Dave Mazza, CEO at Roundhill Investments, father of the MAGS ETF. What's up, Dave? Good morning.
Morning. Pleasure to be here.
Hey, your MAGS ETF has been a focal point for us again this week in trying to figure out the direction of the market. My guy Kevin Green was telling me yesterday the chart for it looks pretty good right now, despite pulling back a little bit off the highs. What do you think these companies need to deliver to ramp us back up to records?
No, you're right. The MAGS ETF really hasn't slowed down, even with some of the volatility. We've actually saw really strong inflows into the fund on a year-to-date basis. As people are still positioning to what has been the winners, even with some of the talk about rotation. I think heading into earnings tonight, and we got 3 of the MAGS 7 coming up with Meta, Microsoft, and Tesla, is really going to be paramount. I think there's different stories for each of the names. As you alluded to in the intro, Meta is a company that, on a fundamental basis, people could say, well, look at the issues with DeepSeek, whether that's true or not. And that stock, probably should be down a bit more. But the price chart on Meta continues to look great, has tons of momentum behind it. I think looking for earnings tonight, we're really going to see what's going on with Llama 4. They've already pre-announced their CapEx, but I do think at this point, and especially with Microsoft, investors we're getting to the point where we need to see clarity on when the ROI of all this investments comes to fruition. And so, especially in the context of what DeepSeek may have potentially done with increasing efficiency.
We're going to talk about these options trades in a moment as we do in this segment. But for the ETF investor, for the more kind of passive investor, I'm curious, Dave, how big are the flows? How big is this product becoming? I mean, you guys really nailed it with this thing, I got to say, because the concentration of the market is such a big story. And if you are in the market, you're getting skewed towards these companies, then it seems like why not just then go for the gold and take these companies out on their own? You're up 57% in the last 52 weeks on this, whereas the NASDAQ, which is like the bastion of tech, is only up 22%. So how are people fitting this into their strategy?
Yeah, no, it's interesting. So you're absolutely right. The Magnificent Seven ETF has really been embraced by investors and traders, especially we see a real increase in volume around earnings events, and we would expect to see that today because you're absolutely right. Because of the concentration in the market, the Magnificent Seven has essentially become the market. And we're seeing a large group of investors, particularly as this fund recently crossed $2 billion in assets under management, just make that trade, to your point, saying, let's remove the tail of exposures. Just give me the names that actually are driving the market higher and potentially outperform. Now, of course, that concentration could come with a risk. But what we've actually seen is on some of the downside, the Magnificent Seven has actually held up better. I mean, just look at it year to date. We have Meta up over 15%. Of course, there's been a bit of a pullback in some of the other names, but that sort of basket, these stocks actually work really well together because Magnificent Seven is is traded back to equal weight every quarter. And so you actually inherently, with that equal weighting and concentration, are benefiting from selling your winners, taking that profits, and then rotating back into the laggards in the Magnificent Seven group.
It does kind of almost feel like you've invented a sort of new way to invest, because there is also just this idea that you should invest with conviction. There's been a lot of studies. I've seen the reports back in my equity reporter days about the concentration studies within portfolios, where once you get beyond like 25 stocks or something, they all just kind of start bouncing off each other. So the idea that you can invest with conviction in a group that has enough kind of like product diversification across these 7 companies that you can get quite a bit of different looking charts for each of them. I mean, Microsoft looks totally different. I mean, Microsoft looks like a company that's just been kind of churning along, whereas Meta rips in the middle of a DeepSeek sell-off that's causing a drop in NVIDIA and others. So you're getting a surprising amount of dispersion within just only 7 companies.
Well, yeah, so there's sort of an interesting interplay going on, to your point. So as you noted, there's been tons of studies that actually a lot of people over diversify, and concentration because we've been taught to diversify, tends to have a bad name. But what's interesting is when I think about diversification, it's really your asset allocation mix. It's less the diversification that you have in perhaps the names that you like or the individual stocks in a portfolio. And so this strategy, this ETF, does exactly that. So the impetus originally was to create a precision tool for investors and traders to access these names. Of course, we couldn't have predicted just how robustly these names would have outperformed. But look, going ahead, to be quite honest with you, the market itself, and in turn the Magnificent Seven, has become more fragile. Even though I still think there's quite a bit of a bullishness in the markets, whether that's animal spirits from retail investors, a continuous bid into passive being driven by target date funds, and things of that nature. Plus, these companies have delivered on revenue and earnings, unlike the rest of the market. And so it's really hard for me to be able to see durability in a rotation until we have clarity from sectors outside of big tech, of the Magnificent Seven, to do so. And to your point, even though it's just 7 stocks, there's thousands of companies that each one of these names own. So investors actually, because of the concentration in the market, because companies like Meta, Alphabet, others have really scooped up a lot of attention, and other companies, whether that's in the social media space or in the consumer goods space, that you can really benefit from having that more precise exposure.
All right. Case well made. Thanks, Dave. Appreciate the update on the thoughts and how folks are using it. Good stuff.
Thank you.
Let's look at some options. Let's trade it. George Tsilis joins us for a look at Meta and Microsoft. All right, so there's the basket approach, George. Give me a bullish trade on Meta. Hit me, because we got like 3 minutes.
All right, sure. Yeah, if you're bullish on Meta, obviously this one's expected to have quite a bit of volatility. About $43 is the expected market maker move. That's a 1 standard deviation move by expiration on Friday. So what we're going to do is we're going to sell the near-term options to capitalize on this high implied volatility expected move by structuring essentially a long call diagonal spread. So this is a bullish trade, and what I'm going to essentially do is I'm going to sell an out of the money option, the 720 call. That's again going to expire on Friday. And then I'm going to use the proceeds from that expensive option to finance a February in the money option. I'm going to buy the 660 call. So I'm selling the 720 that expires Friday, buying the 660 call that expires in February on the monthlies. And these are 23-day expirations. So if you put all this together, essentially you would outlay about $25 a share or $2,500 a contract. So in essence, if you do see the stock stay well contained within the confines of that market maker move, then ideally that 720 will expire worthless, to which time, if you do hold that February contract, you would essentially have about 685 would be your break even. Again, if you hold that February expiration or February contract to expiration.
Okay. All right. Buy 660, sell 720. Okay. Why not? I mean, pretty straightforward call diagonal. You get to take part up until a point, and obviously you've got a little vol bid in here, so take advantage of it. I mean, 720. I think you're having a good problem if you're maxed out on this, right? If Meta rips to $50 or $40 or whatever. How about Microsoft, George?
Yeah, and so in this case, if you look at the stock, we're actually trading still well below the lows that occurred back in July. So, I mean, this one's just been trending sort of sideways over the past 6 months or so. So, in this case, if you're bullish, we have to kind of give additional time and not worry so much about the volatility move in this case. So what I'm going to do is outside of the market maker move, actually I'm going to go out to February with 23 days to expiration, and I'm going to buy a bull call spread. So I'm going to define my risk, define my return, and then let this play out over the next 20 or so days. So I'm going to buy the 445 call, and then I'm going to sell the 455 call against it. So altogether, this would cost you about $4 a share or $400 a contract. So in essence, this is a slow grind, higher kind of trade. 449 is your break even, and then at 455, that's where your max profit is achieved at $6. So I'm outlaying $4 to potentially make $6 in this case, and that only occur if the stock hits 455 or higher by expiration. Based on the current price, it's not too far off, but keep in mind there's a lot of volatility out there in this market, contingent upon what's happening with CapEx and all the AI news around some changes that are expected to come.
All right, nice. Like the trades, George, a couple bullish approaches and different charts. Do you think the kind of vertical is a little bit more geared towards the stock that's had a little bit more chop, whereas kind of the more aggressive approach for Meta seems to work with the trajectory? Thanks, GT.